Hey there, this is Ankush here, and I welcome you to the third episode of Trading with Candlesticks. Today we will be discussing the concept of support and resistance. And towards the second half of the video, I will also be explaining a strategy which is based on support and resistance. So let's begin. First of all, what is support and resistance? As I had explained in my second episode, support and resistances are zones and not particular price points. Now, support is a zone where buyers start entering into the market and sellers move out, which means we are expecting the price to move up. Whereas resistance is a zone where the sellers start entering the market and buyers start to move out, which means we expect the price to go down. The question is, how do we know that the buyers are into the market? And that is based on the candlestick formations, which was covered in the second episode. So typically at support zones, we will see bullish candlestick formations, whereas at the resistance zone, we will see bearish candlestick formations, which indicates us to sell. Now, this being said, any resistance or support does not last forever. And at some given point in time, the resistance or support is breached by the price. In this case, we see the price has broken the resistance and moved up. What happens in this case? Interestingly, the zone which was so far acting as the resistance zone will start working as the new support zone. And the market or the stock price has to find a new resistance. This new resistance can be based on historical price points, or in case if the stock is trading at an all-time high, then the stock has to find its new resistance. It's like the stock is standing on the terrace. And we have seen so many stocks like Reliance, Nestle, HUL, which had reached the all-time high and then it just continued to zoom up for a very, very long time because there was no resistance defined in the history. In this case, we have shown the resistance and support as horizontal lines, but in reality, these resistance lines could be trending either upwards or downwards. The one thing which we have to note, the more horizontal the resistance and support lines are, the stronger those resistance and support lines are, and they behave as a trader, I'm more confident when the price point reaches a horizontal support to buy, and I'm more confident to sell when it reaches a horizontal resistance line. Let's look at some practical examples on how this works. So the first example which I have taken is from a Forex market. This is a chart plotted in 2013 between British pound and US dollars. If we see between September to, I would say, mid of November or even end of November, the price was pretty much trading in a given range, and we can see that from the resistance it came down to support and back and forth a couple of times. Whereas in end of November it did break, and then the price range which was acting as a resistance level started to act as a new support, and then the prices moved further higher. So this is how it worked in a Forex market. Let's look at an Indian market example or a couple of them. One I have taken is TCS, and this, if we see, I have taken a price chart from last July onwards, and what we see is a price point of 2300 is acting as a very strong resistance over here, and over last 1 year I would say there have been almost approximately 10 instances where the price has returned from 2300 backwards. Now, if we see, this is a horizontal support line here, or resistance line rather, whereas there have also been a lot of diagonal support and resistance lines, and these, if you see over the period of last 1 year, has been breached many a times. So this is what I was saying, the more horizontal the line, the stronger is the resistance and the support. And what's happening now in TCS is it's again over last 1 month, it's really trying to break this 2300 resistance line, and if it breaks, then 2300 will become a very, very strong support zone for TCS. So I would say please have a look out. If it breaks out, it does give you an opportunity of buy. Let's look at another example, Infosys, which is trading at an all-time high right now. Here I have taken a 5-year chart, and what I would ask you to focus on is the support or the resistance line which has been drawn at a price range of 500. Let's go back to 2015, which is about 5 years back from now. Yeah. If you see this 508 or 500 has been acting as a resistance, flipped, started acting as a support, again flipped, resistance, support again in the range of 2016 to 2017. The prices dropped below 500 end of 2016, and from there till I would say 2018, it has been acting as a very, very strong support. And post 2018, once it flipped, and 508 or 500 price range has been acting as a very, very strong support. In fact, if you see the meltdown which happened because of COVID also stopped at 500 range. So this is where the support and resistance lines act interchangeably as a zone, but we have to make sure and focus on where is the price point. If it's above the given zone, then it's a support zone. If it's below the given zone, then it's basically the resistance zone. So what I would also suggest is you could take in some line graphs, some candlestick charts, draw your own support and resistances, because this will give you an idea as a trader, where do you want to buy the stock and where do you want to sell the stock. So for example, if you see Infosys, we also have this trend line which was acting as a resistance right now. And if you see, it's trending all the way, this particular line as well, all the way back to 2016, 2015. So we can draw this. So this was short about support and resistance. Let's look at the trading strategy, which is, I would say, a two-step trading strategy for trading in the market. Yeah. Step one. Step one is we need to identify the trend, which means if a stock is in a bearish trend, I don't want to buy that. I want to sell that. How do I know it? Simple. Draw a support and a resistance line. If it's trending downwards, it means it's a bearish trend. Whereas if it's trending upwards, it means it's a bullish trend. Now, as a trader, I do not want to go against the market. What I want to do is identify the trend and go with the trend. The question is why? Because as an individual trader, I am a really small player and I cannot fight the force of the market. So idea is not to fight the force of the market, but to identify the force or the direction of the force and then place my bet in the direction of the force. So this is step one. First is identify the trend, which will give you a direction whether you want to buy the stock or sell the stock. Step two. Now, I want to look for opportunities where I get a breakout of a resistance or a support and use the concept that the same zone which was acting as a resistance earlier will start acting as a support now. So let's take a look over here. Now in this example, this line was acting as a resistance zone, and if we see, we have got a breakout over here. Now a lot of people, based on this breakout concept, end up buying the moment they see a price breakout, because they know the concept that once a price is broken, the old resistance zone starts behaving as a new support. But what typically happens, how emotions come into the play? The moment the price breaks out, a lot of people who have actually bought the stock at a lower price see a new high in a long time and they rush to book their profits, which is why the stock price typically gets pulled back towards the resistance zone or the new support zone. And the idea is, as an experienced trader, we should enter into the stock once this pullback has happened near the new support zone. That is where, post which, the price shoots up once again. So we need to wait for another bullish candlestick formation before we make this entry. Now the common mistakes are that we end up entering, or a lot of traders end up entering the moment the price breaks out. And when this selling or the profit booking happens, typically we call it as a pullback, a lot of traders exit in a panic, worrying that the breakout was false and the price will fall back down. Or even if they do not sell, if they hold their emotions together, they will end up selling the moment they get a break-even price or even a very small profit. And that's mainly the fear or the emotions playing. What a well-planned trader will do is a well-planned trader will wait for the pullback to happen, look at a bullish candlestick formation, and that is where he makes his entry. So our concept of buy low, sell high is very much retained in this situation. So from my point of view, it's very, very important to wait for this pullback. Nonetheless, there are two schools of thought. Some people still believe that we should buy the moment there is a breakout, because to be honest, there is no assurity that this pullback will happen, especially in the Indian market, since the Indian markets are closed for 18 hours post 3 p.m. till the next day morning 9 p.m. and a lot can happen in this 18 hours. The situation, what happens is, if there is a news in the post-market hours, there will be a gap up. So there is a possibility that you might miss out on a big bull run or this gap up opening. But I think that's a risk worth taking, in my opinion. So let's briefly look at the two schools of thought before we close the video. See, or it's even my school of thought is that once the breakout happens and the pullback happens, I would like to buy in this zone. Now we cannot buy exactly at the bottom, but this is the buying zone for me. Whereas a lot of people end up buying the moment the breakout happens. Now you do capture the big moves here or the gap up openings where the pullback does not happen. But at the same time, the question is, are we patient enough to wait for this pullback and then allow the prices to shoot up? For me, I would say it's person to person. There's no right or wrong over here. I play in a safer manner. If you as an individual has a higher risk appetite, you could go by the breakout strategy as well. But please be aware, there is a lot of false breakouts and there is a possibility that you might get stuck up in a false breakout. So this was it about support and resistance and a simple strategy which can be executed in day-to-day trading. We close the video once again with a simple dial-in wave theory. Find the chart's rhythm before you trade. Now, if you like the video, I would request you to click the subscribe button and do not forget to hit the bell icon so that you get regular updates from my channel. Till next time, stay safe, stay healthy, and enjoy your trading. Thank you.